Hi everybody. In this video we'll calculate gain or loss on the early retirement of a bond and write related journal entries. You can write your answers to these exercises on a piece of scratch paper, or if you wish you can download the Excel file embedded on the page above the video. Salvage Company retired $500,000 bonds by buying them on the open market for $98. On the date the bonds were retired, the unamortized discount on the bonds was $24,000. So the face amount of the bonds, $500,000, and the unamortized discount, $24,000. They purchased them at 98% of the par value of the bonds. So calculate the price paid for the bonds. I just told you how to do that. Pause your video, do the calculation, and when you come back, check your work. So the price paid for the bonds is $490,000, calculated at the par value or face value of the bonds times 98% in this example. That noise you heard just a moment ago was my little puppy barking. I just put him in the other room. Hopefully he'll be quiet for a while. Next thing, calculate the carrying value of the bonds before retirement. These bonds were issued at a discount, and they told you that the unamortized discount on the bonds before retirement was $24,000. Remember that a discount has a debit balance, while the bonds payable account has a credit balance. So you must subtract the unamortized discount from the face amount of the bonds to calculate the carrying value of the bonds issued at a discount. So $500,000 minus the unamortized discount of $24,000 equals a carrying value of the bonds of $476,000. What is the gain or loss on the retirement of these bonds? The calculation is really quite easy. The calculation is cash paid for the bonds minus the carrying value of the bonds. Whether we have a gain or loss is something I want to talk with you about right now. First, the carrying value is a net liability on the books. Whether it's a premium or a discount, it doesn't matter. The carrying value is a liability on the books. Gain or loss, like I said, is calculated by subtracting the carrying value from the cash paid to retire the bonds. The benefit we receive from the retirement of the bonds is extinguishment or relief of debt. If the cash paid is greater than the benefit we receive, we must record a loss. In other words, if the cash paid is greater than the carrying value, we have a loss. If the cash paid, however, is less than the benefit we received, then we must record a gain. In other words, if cash paid is less than the carrying value, we have a gain. In this case, we paid $490,000 to retire the bonds. They had a carrying value of $476,000, so we received less benefit than the cash we had to pay for that benefit. Therefore, we have a loss on the retirement of bonds. Go ahead and prepare the journal entry to record the retirement of bonds. There are 4 accounts affected by this journal entry. We have to record the loss, we have to record the cash that was paid, and we have to get both the bonds payable and the discount account off the books. When you write that journal entry, start your video again to check your work. Debit bonds payable, $500,000. Debit loss on retirement of bonds, $14,000. Credit discount on bonds payable, $24,000. And credit cash, $490,000. Let's do another set of very similar calculations and journal entry, but we'll talk about a company that had a premium on their bonds before retirement. Holiday retired $500,000 in bonds by buying them on the open market for $102. On the date the bonds were retired, the unamortized premium on the bonds was $27,000. Calculate the price paid for the bonds. Holiday bought $500,000 worth of bonds at 102%. So the price they paid to retire those bonds is $510,000. Calculate the carrying value of the bonds before retirement. Remember that a premium has a credit balance. The bonds payable account also has a credit balance. So you must add the two credit balances together. You must add the unamortized premium to the face amount of the bonds to calculate the carrying value of the bonds issued at a premium. $500,000 face amount plus the $27,000 of unamortized premium is a carrying value of $527,000. What is the gain or loss on this retirement? Cash paid to retire the bonds was $510,000. The carrying value of the bonds was $527,000. So we recognize a gain on retirement of the bonds of $17,000. We had to pay less cash than the benefit we received. The benefit we received is extinguishment of debt, $527,000. We only had to pay $510,000 for that benefit. Therefore, we have a $17,000 gain. Go ahead and prepare the journal entry to record the retirement of these bonds. When you finish, start the video again and check your work. Debit bonds payable $500,000. Debit premium on bonds payable $27,000. Credit gain on retirement of bonds $17,000 and credit cash $510,000. Well, that's all for this video. You will see a problem on the exam that is somewhat similar to this. That's why I added this video. See you next time.